Hi, ladies and gentlemen. This is Shelley Kraft, and we're coming to you live with a Wall Street view. We're at the Cambridge House Resource Conference in Palm Springs, California, 2012. I have Simon Mikhailovich of Eidesis Capital, and we're going to be talking about today's insurance, but let me not mislead you. Wait till you hear what today's insurance really is. Welcome to Wall Street Views.
Thank you.
It's good to have you. Okay.
Good to be here.
Just a couple of guys hanging out in Palm Springs, right?
Absolutely.
What is today's insurance by your standards? And let's talk about this a minute.
Sure. Well, insurance generally is a concept that is not financial concept. In the world of finance, people understand insurance as a hedge. So a hedge is a financial instrument whose mark-to-market value moves in real time in the opposite direction of whatever one seeks to insure. The problem with this concept is that hedging uses financial instruments that depend on functioning markets. So in today's environment, given what we have lived through in 2008 and the risk of systemic disruptions, if one starts thinking in terms of insurance or protection against systemic disruptions, then the concept of hedging becomes problematic, because insuring against systemic disruptions within the system is impossible. The counterparty that is providing the insurance may not perform and is not likely to perform if whatever you're trying to insure against will happen. The prime example, of course, is Lehman Brothers that sold credit default swaps to a lot of counterparties that were meant to protect people against a rise in credit risk. And of course, when credit risk went up, Lehman Brothers was unable to meet their obligations, and people were not paid on insurance. And in fact, the only reason the system remained sort of standing, if you will, is because AIG, that provided some $200 billion worth of insurance with money they didn't have, and could not pay those claims, was supported by the U.S. government. So, but for the U.S. government, counterparties of AIG would not have been able to get paid. They would have lost money on their long positions, and they would have not collected anything that they thought was protecting their positions, which would have resulted in a string of failures, which is why the bailouts had to be done, or were done at the time. So the question today is, if one is thinking in terms of how does one protect his investments against a systemic disruption, and it doesn't really matter whether one thinks the disruption will or will not happen, the same way one does not buy car insurance or house insurance because one knows that the house is going to burn down. You buy it because you cannot afford to lose the value of the house if, God forbid, something were to happen. So in that sense, how does one think about insuring one's wealth or capital against a systemic disruption? I call it disruption. It could come in various forms, obviously. And when one goes through the litany or the list of things that potentially are outside the system, these are real assets. So it could be real estate, it could be art, antiques, it could be diamonds, it could be something real. The problem with a lot of things that I just said is that they're not typically liquid during times of distress. Diamonds require expert opinion in order to establish which type of diamond it is. Real estate obviously is not very liquid when people cannot access credit. And so when one goes rigorously through various types of assets and asset classes that are available, one ends up with gold or precious metals. There's a reason why for 5,000–6,000 years people have resorted to this metal. It almost doesn't really matter whether it's gold or it could have been seashells, it could have been something, but people have decided that gold is what they choose because for its convenience. It doesn't corrode, it's divisible, it's portable, and all those things that made gold the choice for wealth preservation, and when gold used to serve as money, as a medium of exchange. So today, of course, gold is not a medium of exchange, but it is a store of value. And it is probably the most ubiquitous material that is recognized around the world as a holder of value. So of course a lot of people own gold and have owned gold recently, but a lot of people do it through financial instruments such as ETFs or futures. And if we go back to where we started this conversation, it's clear that if you own gold in the form of financial instrument, you really don't... Paper gold. You don't really own gold, you have exposure to gold. But whether that exposure can be collected upon is really the same issue that we said with Lehman Brothers.
So let me just interject. So why wasn't Lehman Brothers too big to fail, whereas AIG was too big to fail? And I always wondered about why they bailed out AIG but not Bear Stearns and not Lehman Brothers. So let's take 1 minute for your opinion on that.
Sure. I think Bear Stearns was bailed out. It was bailed out through a sale to JP Morgan, but the sale took place, as you remember,
$2 a share, right?
at $2 a share. But that was not the punchline. The punchline is that Bear Stearns held some $30 billion of assets that JP Morgan would not take. And those assets were bought by the government or taken by the government. They're so-called maiden lane facilities that the government is now auctioning off, as you may have heard recently, to various investment banks. And that is what enabled that transaction. If you took that money straight out of the capital of Bear Stearns and did not facilitate the trade to JP Morgan, then we would have had another Lehman Brothers. So they bought time. Now, when it came time to Lehman Brothers, I think the government felt for a minute there that capitalism should work, and they tried to make it work. But when they saw the consequence of this one firm collapsing, they didn't have the nerve to go any further. And of course, the problem with AIG particularly is that whereas Lehman Brothers, you can think of it as a hub and spoke, where Lehman Brothers was one of the peripheral entities in the outer wheel of the spoke, it turns out that when it came to subprime insurance, or insuring against subprime defaults, it turned out that AIG was the hub. And all counterparties, and counterparties being Goldman Sachs, Merrill Lynch, Morgan Stanley, Societe Generale, and other banks that have sold investors these CDOs and securitization products that were backed by subprime mortgages, they in turn all went to AIG to protect themselves to collect. But of course, if AIG was not going to be able to pay, as we now know, to a tune of almost $200 billion, which is not a trivial sum of money even today, not what it used to be, but still a lot of money, it became clear that the entire investment banking business was going to collapse. And that's when the government lost the nerve. And they did what they did. Now, of course, the problem is that that solution, in the financial terms, increased correlation in the markets. Correlation in the sense that reducing risk is decorrelating, is in other words, dispersing the risk across broader number of risk takers, if you will. However, when the too big to fail banks and companies are now probably twice as big to fail, and when the leverage in the system was simply taken out of the private sector and put into the public sector, and when the American Federal Reserve is providing lines of credit to the European banks that are teetering, and the northern European countries are bailing out their southern neighbors, all of that increases correlation as opposed to decreases correlation. It increases interdependency and interconnectedness in the system. And therefore, when no one can fail, then the chance of everyone failing rises. And if you keep doing it, which seems like the government would like to continue doing it, you go to a place where the options are binary. It either works or it doesn't. And if it doesn't work, then the consequences, the severity of outcome is very high. And so that's why I feel, my firm feels, that financial professionals and investors in general need to be thinking in terms of not conventional hedging strategies that strictly rely on performing financial system and working markets, but they need to think out of the box, and they need to think in a different way, that their eggs are not in one basket, because it turns out that all financial instruments, where you think they're in different baskets, they're all in a bigger basket, and the bigger basket is the system. And so financial system, now that's not a life and death situation. That's about, as H.L. Mencken once said, when they say it's not about the money, it's about the money. It's about the money.
So in other words, you come to a conference, for instance, Cambridge House, and there's no question about it. The underlying tone is precious metals. And the major reason why investors are coming here is because they're trying to figure out what to do with their money, their assets, their shortfalls, their taxation, government influence, and really, what do I do? So you're looking at it from an institutional viewpoint.
Yes.
Now, you have people who are looking at it from what's going on in my life, my individual, family. And you know what? I'm hearing the same thing. I'm hearing you're doing the same thing that I'm hearing individuals tell me, you know what? I don't trust the government. I don't trust the paper. When they need money, they print it. Sooner or later, that money's not going to be worth anything. I guess I better take physical delivery of gold. So that's a commonality that I'm seeing, that we've got some smart investors, because I'm hearing from a smart institution that you're doing the same thing. Isn't that going to have a direct relationship to the price of the underlying precious metal?
That's a very interesting question. It's a very timely question. There's a very respected, extremely successful financial firm called GMO, Grantham, Mayo, Nuttall. It's a Boston-based firm. Jeremy Grantham is a extremely well-respected and incredibly smart head of that firm, who posts quarterly letters that are very widely read on the website. And I went to that website looking for his latest letter, which is not up yet for the end of the year. But what I did see is a white paper on gold, and on gold prices and gold demand. And what I think is interesting about that paper is that it provided some information on physical demand. Now, the gold prices have clearly gone up very much in the last 10 years. But the physical demand for gold, physical, not paper gold demand, not securities or derivatives or futures. Physical demand for gold overwhelmingly has come from the emerging markets. Now, what that told me is that, and emerging markets, specifically India and China, populations in those countries are suffering from distrust of government, and they're suffering from the dearth of choices as to how to protect their money. And so, whereas in the West, I believe up to now, gold has really been a trade where financial professionals and some investors are speculating on the price of gold, which is the concept we started out with, hedging. It's the anticipatory increase in price or decrease in price based on sentiments of what people think might happen.
It's emotional.
It's an emotional, exactly. It's a way of speculating based on prices that move on emotional anticipation of things. It is clear that in the emerging markets, the gold trade, quote unquote, is not a trade at all. It is really a store of wealth. It is a legitimate purchase of an asset, a holding, as opposed to getting an exposure to something that protects people's wealth. So my thinking on that is very simple. If it is in fact true that up to now, in the West, where the bulk of the financial assets resides and financial wealth resides, gold has really only been a trade and not a source, or I should say the demand for it has not been driven by desire to have an insurance or to have an asset that cannot be replicated or cannot be easily sort of perverted through financial transactions. We have not seen anything in terms of demand. The price so far has been driven through financial transactions, not through really physical demand. Now, we know that gold, there's only so much of it. So physically, if Western investors, pension funds decided to allocate a minute portion to physical gold, there's no question that there will be a material impact on prices to the upside.
So, ladies and gentlemen, continue buying your physical gold while you can, before the prices get crazy. That's the way I'm looking at it.
That is true.
So let me just summarize by thanking you for coming on. You're very knowledgeable in the area, and I'm sure our viewers will appreciate your words. Simon Mikhailovich, Eidesis Capital. Today's insurance was the topic. Do you want to give out a website for them to visit?
Eidesiscapital.com.
That's EIDESIS capital.com. Thank you for coming on.
Thank you for having me. Thank you.